Drew Tignanelli. This is our June update here with Mikey. What's
Happy to
up,
be
Mikey?
here. I'm happy the weather's changing.
Look at you. Look like you're doing quite well there, little thin guy that you are now. What happened?
I was given a lot of good reasons to improve my health so that we can, all things continue to stay good. I think everybody should improve their health, and I took it seriously. So,
There you go. And I'm
a
glad
little
to
less
hear.
of me.
I'm glad to hear that. So, what do we have videos coming this week or this month?
We do have a video coming later this month. It's not quite ready yet, but we'll just kind of allude to it, so it won't be in this email. But it's some of the five biggest mistakes we've seen clients make. That'll be coming out a little bit later this month. But with the email sent out with this video, we will have an article, and it's for people who came to us thinking their finances were covered. Here's what we found, and that's by Justin Linthicum.
Yeah, Justin's a good man. And also, Mike, if somebody wants to ask us a question, and if you have a friend that you want to say, hey, why don't you just ask these guys? You can email questions@moneyrichesandwealth.com. And here's the important thing to know. And I want all of our clients and people who get this Pulse video to know we do not harvest emails from those who ask a question. I just answer it. And if they respond back, I answer their follow-up question, and that's it. We do not take their email. So it's a safe place. Send their question, we'll answer their question, and that is all we do with that email. So just want to make that very clear. And so feel free to share it with friends if they want to send us a question. We're more than happy to answer questions@moneyrichesandwealth.com. What's going on in the market there, Michael?
Well, it feels a little bit like Groundhog Day. I'm going to start off by saying May markets were strong and ended strong. And writing that, it's almost I only had to change the word May from the previous month. So markets are strong again. One of the things to take note as we've had this kind of extended strong market is that the average bull market is about 64 months, and this current bull market's running at about 42 months. So it's worth noting. But one of the things I love about the idea of looking at a number like the average length of a bull market and trying to make some assessment about where we are today. Liz Ann Saunders, Charles Schwab's lead market analyst, who I believe actually is retiring in the next couple months. But one of her great quotes is, as a predictor, averages are average. That means that just because we share that note, there are things to take away from it, but doesn't mean there's 22 months left or 24 months left, whatever, in a bull market, or that we're going to make any real big decisions off that. But when it comes to market data, some of the other things that are important to note is that the April data now shows us that especially energy has pushed that cost of inflation higher, up to 3.9%. And this is actually notable. I mean, that's a 0.7% increase from the prior number. If your target is 2% and you're going from 3.2, 3.3 up to 3.9, wherever it was and is, that's notable. And what I think is notable about that, Drew, is that we talked about it a little bit last month, but this month we have a new Federal Reserve chairman, Mr. Kevin Warsh. His parents must be from Baltimore because they know how to clean a car as you wash it. And he's coming in to his position with inflation kind of up, but also still that present pressure to lower rates. But
Yeah,
um,
but one thing is of the while we're taping this video, right? I was looking at the commodity markets, and the price of gasoline was $3.75 a gallon on the wholesale market last Friday. Today, it's all the way down to $3. Now, if that trend continues, you could see a big upset on those inflation numbers. So the media likes to make a big thing out of this inflation thing, but I'm telling you that inflation is something to be worried about. It's not something to be concerned about. That's the way I look at it. That's my prediction.
That's your
Remember,
prediction.
predictions are leverage.
I think some of us will still worry a little bit about inflation.
I'm not worried about inflation, but
But
anyway,
well, so again, this is just giving commentary to what we see out in the markets. And then with that information, I didn't put this in the notes for Drew to have advanced knowledge on, but another thing to consider is that there's this pressure for lower interest rates, but right now, if we look at kind of futures markets, what we're seeing is the potential maybe for a short, pointing towards a potential short-term increase in rates before rates starts going down. But again, it's conjecture.
I doubt seriously Kevin Warsh is going to raise rates, but we'll see. And nonetheless, we've got some topics we got to cover.
Sure. Well,
And
so all of that you can't really do anything with. But what can you do with the knowledge that what should we be thinking about when rates are high?
what should we be thinking about when rates are high? I don't know. You tell me.
All right, so I'll tell you. I mean, this is again, these are my words, at least I don't think I stole them from someone, is the longer a market stays high, the further out you should consider your cash needs. So we're always telling people, hey, next, 3 to 7 months, 3 months to a year, let us know if you're going to be needing cash. So we can always make sure that it's kind of held aside for you. Well, the longer we get into a bull market, maybe the longer further out we should be looking at those things. Maybe even as high as 3 years should be considered.
Yeah,
Uh,
because if you do get a bear market, they tend to last a couple years. So you need to think about that. And I say it to a lot of people when they ask me when should I take my RMD, I say, well, the markets are high right now. Let's go ahead and take it now. Let's not wait until the end of the year and assume they're going to still be high. So
right?
when you get in a bull market for a while, start thinking about possibly taking your RMD earlier in the year, not waiting until the end and hoping that it's even higher. Because if the market goes down and you have to take your RMD at the end of the year, that's not a pretty picture.
Yeah, absolutely. So timing and distributions, like Drew says, considering, if you know you're going to be taking a distribution like your RMD when to take it, but don't forget to make sure you're still doing your planning. Even if you do your RMD in the beginning of the year, if you're thinking about being charitable later in the year, maybe make those plans right up front. So another one, and this is probably my favorite consideration of what to do when markets are high, and this one is again for retirees, being more cognizant of your distribution rate or your spending rate. Because one of the things that can happen when we go through periods of time like this, where we've had, considerable higher strong markets for a longer period of time, is those markets have the ability to cover up problems in our spending rates because, you know, your spending rate may have gone up, but you're not really noticing it. The red flags aren't going off because your total account values keep going up even though your spending is up. But the thing you got to be aware of is that in the event that those markets change course and that market performance isn't there anymore, what is that spending rate going to be doing to your long-term retirement plan? So making sure that you reassess your spending rate and your distribution rate before the market changes courses.
Yep, that's a good one. And if you do all of a sudden get a big hunk of money, Mike, you might want to consider putting it in the market slowly as opposed to boom, just plopping it in there. Now,
Abs-
if we were only 12 months into a good bull market, I'd plop it in there right away. But
yeah,
when you're 4 years almost into it, and as strong as this one's been, you really have to sit back and say, can it just keep going higher without a downturn, at least a good correction? And let's define the difference between a bull market and a bear market. A bull market is one that goes up consistently without going back down to a previous low. A bear market is when an up market corrects by more than 20%. At least that's in general what the difference between a bull and a bear market. And so for the last 3.5 years, we have not had a market pullback of more than 20%. A correction is a market pullback of 10% or more. We've had a couple of those, but we've only came right to the edge of 20%. And also, even if it goes over 20%, it has to stay there for a little period of time, like a month or two, and then it's considered a bear market. So,
absolutely. Well, I just want to revisit before we close out on these topics. On the dollar cost averaging, we're talking about a significant amount of money compared to your net worth. Not, I mean, $10,000 might be a lot of money, but if you've got, a few hundred thousand, $1 million, $10,000, you might as well just put it in. And then the timing wise, we're not talking about putting it in over 3 months. We're talking about large amounts of money put over long periods of time. And the biggest thing that before you implement a strategy like that, you have to consider is the risk of the missed growth compared to the risk against the loss. I mean, it's just something you have to say like, well, if I'm going to do this over 2 years and I miss a certain amount of appreciation that I would have gotten because that bull market's just going to keep going, how do I feel about that versus if I put all this in a few months or less, and that happens to be right before it goes down? Those are weighting factors that everyone needs to consider for themselves.
Sure.
But yeah,
All right. Anything else, Mike?
no, I think that's it.
All right. Well, this is Drew Tignanelli saying God bless.